Ever wonder what's really behind that new skyscraper going up downtown? Or how the price of your own home somehow connects to what's happening in global finance? Well, behind every single piece of property, there's this massive invisible financial engine. So today, let's pop the hood and take a look at how it all works. The world of real estate capital markets.
And just to wrap your head around the scale we're talking about, the estimated value of all the real estate on the planet is over $300 trillion. That's not just big, it's the single largest asset class in the world, by a long shot. It makes stocks, bonds, you name it, look tiny in comparison.
And hey, this isn't some abstract number that only matters to bankers. For the average person, for folks like you and me, our home is usually the single biggest piece of our wealth. For most people, it's worth more than all their stocks, bonds, and other assets put together. It's way more than just a roof over your head. It's the financial foundation for millions. So yeah, understanding how it's all financed, it's a pretty big deal.
Okay, so why do we even need this complicated financial system for something as solid as a building? I mean, we're talking about bricks and mortar here. Well, it all comes down to solving one huge fundamental problem.
Here's the thing. Real estate is inherently illiquid. Just think about it for a second. You can't just take a few bricks from your house and sell them on the stock market, right? You can't sell a single floor of an office building. Buying and selling a whole property is slow, it's expensive, and it's a complicated process. And all of that makes it a really tough investment for a lot of people.
And that's where this incredible money machine kicks into high gear. Real estate capital markets are basically designed to solve that exact liquidity problem. They found these really sophisticated ways to take a physical, illiquid thing like a building and transform it into a liquid financial product that can be bought and sold in seconds by investors anywhere in the world.
And this pretty much happens in two main ways. The old school way was direct funding. A local bank would give you a mortgage and then just hold on to it for 30 years, keeping all the risk and reward for itself. But today, the game is totally changed. It's all about the originate to distribute model. A lender creates a loan, then bundles it up with thousands of other loans and sells that package off to investors across the globe.
And right there, that's the central tension, the key trade-off in all of modern real estate finance. On the one hand, selling off loans is great. It spreads risk around and opens up a fire hose of capital, which makes mortgages cheaper and easier to get. But, and this is a big but, it can mean that the original lender doesn't have as much skin in the game, you know? Their incentive to make sure it was a really solid, safe loan to begin with might not be as strong.
Okay, but hold on. If we're going to be trading all these things based on the value of properties, we need a really reliable way to know what those properties are actually worth. And believe me, that is way, way harder than it sounds.
Seriously, just think about this. The value of a stock is updated every single second, right? Because they're traded constantly. But your house, my house, it might only sell once a decade. So how on earth do you create a price index that tracks the value of an entire city, let alone a country, when the underlying assets almost never trade?
Well, to crack this nut, economists came up with two really clever solutions. The first is the repeat sales method. The idea is simple. You only look at properties that have sold at least twice, and then you just measure the price change for that exact same property. It's a perfect way to control for quality. The other method is called a hedonic index. That's just a fancy term for a statistical model that tries to figure out how much each feature, like square footage, the number of bathrooms, or being in a good school district, adds to a home's price.
And I guarantee you've heard of these. That famous S&P/Case-Shiller home price index you always hear about on the news? That's a classic repeat sales index. And Zillow's Zestimate? That's a perfect example of a hedonic model at work. Both approaches have their strengths and weaknesses, which is why the real experts always look at several different indexes to get the full picture.
All right, let's zoom in now. We've talked about the huge macro market. Let's get down to the single most important document in this entire universe, the mortgage contract itself. You can think of it as the atom that makes up everything else. So the most fundamental choice here is all about the interest rate. With a fixed rate mortgage, your payment is what it is. It never changes. The lender is the one taking on all the risk that interest rates might shoot up in the future. But with an adjustable rate mortgage, or an ARM, that rate can change. And that means all the risk of rising interest rates gets shifted from the lender directly onto you, the borrower.
Now, you should also know that a mortgage on a house is a totally different animal from a mortgage on an office building. Residential loans are very standardized, with lots of consumer protections built in. Commercial loans, on the other hand, are custom-built, tailored for big investors, and they often have complex features, like penalties for paying it off early and something called a balloon payment.
So what in the world is a balloon payment?
Okay, imagine your loan is set up so your monthly payments are calculated as if you have 30 years to pay it off. This makes your payments nice and manageable. But, and here's the catch, the loan is actually due in full after only 10 years. At the end of that decade, bam, the entire remaining balance is due in one giant balloon payment. The borrower usually has to find a new loan to pay it off, which, as you can imagine, creates some serious risk.
Okay, so we've covered the flow of capital, how things get priced, and the contracts themselves. Let's bring it all home and see how this incredibly complex system, plus government policy, directly shapes your ability to own a home.
In the U.S., you absolutely cannot separate public policy from the housing market. The government actively encourages people to buy homes through massive tax subsidies, like letting you deduct your mortgage interest, or exempting most people from paying capital gains tax when they sell their house. And on top of all that, you have these huge government-sponsored players, Fannie Mae and Freddie Mac, who act like the backbone of the whole system, constantly buying mortgages to make sure money keeps flowing.
So at the end of the day, the mortgage rate you see advertised, the price tag on that house down the street, even your own personal decision to buy or rent, it's all an outcome of this incredible interconnected system. It's a web that connects a global investor in Tokyo looking for a return with your local property market. And it's all constantly being shaped by interest rates, government policy, and what we all think prices are going to do next. Which brings us to one final, pretty provocative question. Now that we've seen how the whole system works and how deeply the government has its thumb on the scale, should it? With all the risks and rewards we've talked about, is actively subsidizing homeownership really the best policy for creating a stable and prosperous society? That's a tough one, and it's definitely something to think about.